What's going on, everybody? Welcome to a capital hungry, higher time frame macro analysis webinar. So, usually at the end, close to the end of a business month or into the start of a new business month, we like to do some macro higher time frame analysis to get a general bird's eye view of the markets and understand price positioning, of course, from a longer term perspective, which can help you forecast movement a lot easier from a macro perspective. And not just that, from a psychological perspective, it's good to get that little bit of a refresh and reset because a lot of people get accustomed to just being tied down to the intraday timeframes or lower timeframes. For the day traders, you can get very used to only looking at the daily time frame, or not even that, just looking at 4 hour and below. And for the scalpers, you can get very used to just looking at 1 hour and below, and of course, like the 1 minute time frame, as you're primarily looking to be in the market for a short period of time. Now, regardless what style of trading you actively use, it's still great to reset and understand what's going on in the markets from a macro perspective and just realize that you can apply the same concepts across different time frames, and it can give you a great sense of what's to come. Now, we're going to start out here and we'll just go pair by pair. We're going to start out with gold. Then we'll look at dollar individually in dollar pairs, and then our yen pairs and equities. Now, in the example of gold, overall, the base case for macro bulls is starting to develop further, especially understanding the current economic environment. What is the current economic environment? Well, going into 2024, policy lag effects are going to start to be more prominent, and it's going to be further highlighted with declines in economic data. And that's not just declines in US economic data. In the example of gold here, of course, we trade gold against the US dollar, but gold is impacted by global events and global data. Obviously, US economic data holds a little bit more weight on the intraday, but there's transactions going on in terms of gold exchange around the clock from around the world, and different events impact gold because obviously it holds that safe haven status. So you could have geopolitical tensions, you could have banking sector failures in other parts of the world, like for example, what we saw in Europe, and it's still going to lead to demand in gold. It's not just solely impacted by events that occur in the USA. So we have to understand that the Federal Reserve, Bank of Canada, Bank of England, Euro Central Bank, Reserve Bank of Australia, Reserve Bank of New Zealand, and so forth, majority of those central banks have raised interest rates in a very aggressive fashion that we saw, of course, through the 2022 period when we were playing that dollar domination narrative. But the policy lag effects of those tighter conditions are just starting to show as we're winding down the year 2023. As we go into 2024, we have an increased probability to see more cracks in the financial markets exposed, as well as more declines in global economic activity, which can, of course, result in gold's safe haven side looking a lot more appealing for investors and traders and overall market participants. So the one thing we have just noticed is obviously from the start of the pandemic, gold has showed significant failure to break above the 2000s and hold above there. We only had a few events that even brought us up to there, which was, of course, the initial fear of the COVID pandemic, lockdowns, gold mining and production facilities being shut down, so a decrease in supply, but demand still being high, and of course, all of the COVID fear that was attributed during that period of time. Then you can see the next time we revisited there was Russia invading Ukraine, still relatively short-lived movement above the 2000s before snapping back. Then it was the banking sector failures with the, of course, Silicon Valley Bank collapse in the US, and then Eurozone following suit. But even though we've had those rejections, we're still not breaking macro bullish structure. And more importantly, we're holding above previous crisis price points, which was around 2008 GFC, of course. Now, personally, through the dollar domination phase, I personally wanted to see deeper downside moves, even coming to the 1500s before really seeing buyers come back into the market from lower demanded higher time frame price points, better pricing. But through the dollar domination phase, when the Feds were aggressively front loading rate hikes, and after Russia and Ukraine events were priced in, that was this movement here, primarily over a year, ending going into 2022, and then of course the end of 2022 there. So we went into about the 1600s before bottoming out. Now, overall, if you followed the last macro higher time frame webinars, it's not like during the dollar domination phase, we were expecting gold to melt. We were expecting to have a very controlled correction to reset higher time frame demanded buy areas before continuing further bullish. Very similar to what occurred after the 2008 GFC during Ben Bernanke's era as the head of the Federal Reserve, when they had the 2012-2013 taper tantrum. In this situation in 2022, the way the Feds aggressively tightened financial conditions after having interest rates at zero and heavily stimulating the markets and economy was by front-loading rate hikes, right? Aggressively front-loading rate hikes over that 8-month period. Here, during the 2008 GFC, the way the Feds tightened financial conditions after stimulating the markets and economy through the 2008 financial crisis there was by aggressively tapering. So you could just go back and Google taper tantrum, search 2012-2013 taper tantrum if you want more information on that. But it's basically the same fundamental concept of shifting the investing environment on its head, going from keeping loose conditions and supporting the economy to flipping that and preventing inflation from spiraling out of control. Same idea here, right? Now, we didn't get as nearly as large of a correction with the amount of liquidity that was still splashing around the system because there was way more of an increase of money supply, and the stimulus was way stronger through the pandemic period than it was compared to 2008, right? Exponentially stronger. So instead, we saw, of course, gold start to respect this bullish structure and going back up to these highs, but still failing to break above the 2000s. Now, you may be, of course, asking, well, clearly we need some important fundamental events to break out higher. What will those events be? And 2024 looks like the period of time where we can see a lot more geopolitical tension start to escalate, such as global military conflicts. And it may not even need to be physical conflict. It could be a Cold War, right? Like a war on an economic front. And the reason for that is if you want to do some research yourself, or if you watch the educational webinars, the majority of times the US goes to war or looks to raid other countries in some way or form, whether it's taking over from a political economic front or it's from an actual physical war front, like we've seen plenty of times in the Middle East and other parts of the world. Majority of the times the US is looking to do that is when the US is facing economic decline. When the US is facing a drop in economic activity, entering a recession, or already in a deep recession, this is where you see an increased probability of conflict coming to play, because then the US can gain more power on a global front through this pretty much a raid, right? Taking over some land, resources, and commodities, and of course, further boosting the US military industrial complex, which is a huge, huge portion of the US economy, right? And just their standing of power. One thing I always say when people tell me that the US dollar isn't backed by anything and it's gonna get overthrown by BRICS or something, is that the US economy and the US dollar It may not be backed by something solid like gold, like it was back in the day with silver and gold and so forth. But what it is backed by is the largest global consuming economy and the largest, most volatile military. What do I mean by largest, most volatile? Well, there are other countries around the world with very large militaries, such as India's getting up there. Of course, you have your classics like Russia and China, but the US is the one to be in the most action. The US has been in a war ever since they started flooding further investment into their military because that's how they hold their position of power. The US dollar is backed by the largest, most volatile, vicious military that's not going to go down just sitting back relaxed. They'll take down everybody with them. And not just that, the US economy is still the largest. China and US can have all of these tensions and all of this drama in the public, but at the end of the day, China feeds off of the US. China's biggest customer is the US, right? So that's just something as a side note there, rambling on. When we see a lot of these people talking about BRICS and the US dollar getting overthrown, that's not something that's going to take place years down the line, another generation perhaps. But anyways, what I was leading into, whenever the US is facing economic decline or going into a deeper recession, this is when you have the highest probability of them starting to get involved in global conflict to bring themselves more power, control, resources, and wealth, and give a boost during these periods of recession, right? This is when they'll start raiding countries and creating propaganda that they have weapons of mass destruction or they're terrorists, and then they just take over all of the gold there, commodities, land, resources, and so forth, and put a puppet government in. This is when they'll start putting sanctions on other countries to try to take over from an economic front and a political side. This is when you have the highest probability of that. Now, with policy lag effects and an inevitable weakening in the US economy, we can have a collection of confirms that can have gold trading above the 2000s, right? We're going to have So, as major central banks still have not completed their fight on inflation, and they're going to need to keep neutral rates up higher for longer, as inflation is going to have trouble remaining at the 2% point without seeing major sacrifices in the employment sector, and especially if energy prices still continue to rise, when we're looking at oil being actively bullish, then you have this inevitable decline in economic data, which is a cascading effect and like a domino effect, because you're going to have global economic data declining, less global business activity, less economic activity, less import and export. We're already seeing the weakening actively in China, where they have to do these surprise rate cuts and further stimulate their markets and economy. We're already starting to see the cooling signs in the US labor market with that jump we've seen in unemployment rate and starting to see jobless claims edging higher from a macro perspective, JOLTS jobs opening, declining, and so forth. PMI figures starting to go below that recessionary grade point, right? This is all just going to create this bubble of fear and a poor negative sentiment towards global economic growth and global stability, which in the essence of gold increases its demand as a safe haven asset class, right? So we do have these reasons, even as a collective, bubbling up where into the new year of 2024, give or take some corrections we still may see, like to set up prices for the new business year, it does look like overall, as all of these catalysts start to bubble up, the probability for gold upside to be breaking above the 2000s, and more importantly, trending above the 2000s is for sure increasing, going to the 2200s and so forth. And then outside of those fundamental events and outside of that macro forecasting on data and geopolitical tensions, even when you're just looking at general order flow, and you can say this is like pretty much like a 1 minute chart, but it's just a higher time frame chart, we can still see that after these highs were printed from the 2008 GFC, you had this corrective phase, period of consolidation and accumulation. Then during the Trump era, you had buyers in control, at least printing new higher time frame highs with Trump and the trade war drama, of course, leading into the pandemic crisis and fear. Then, more importantly, looking at order flow, you can see, and even though we dug a little bit lower on this wick during the dollar domination phase, and even though we could have easily retested into the 1500s, overall, we're still having these candle bodies close well above previous crisis highs. And of course, this as a secondary phase of market structure is just starting to look more like an accumulation rather than an aggressive pullback phase. And then when you understand those events that are bubbling up, if we're not trading back below the 1800s just from a macro standpoint, or if we start to trade above the 2000s with those events coming to the table into 2024, then we're just going to be extending this macro trend to the upside, going to the 2200s there on gold. And during this period of time, what I want everybody to understand is during this period of time, both dollar and gold can be bullish, right? Because during this time, Feds are still going to need to keep rates up. They can't really bring any more new money into the markets and economy. Otherwise, you're just going to spiral inflation out of control, and you're going to repeat what occurred in the 1970s of the Feds pivoting too early before goals were attained, and then inflation getting even worse than it was prior, right? So during this period of time, rates are still going to be up. You're going to get these data-induced pullbacks on the dollar, but because global economic data is declining, because there's uncertainty and poor sentiment and global growth and global business activity, dollar's still going to be holding its position as the world reserve currency and still maintaining that demand as a safe haven currency as well during this global turmoil, right? So this is a period of time where both the dollar can be more bullish, where yen can have way more aggressive bullish bounces, but it won't shift the macro structure unless obviously Bank of Japan shifts their policy positioning, which they honestly may start giving signals towards into 2024. And you're going to see a lot more demand in your safe haven asset classes, because if you don't have that support from central banks during this period of economic downturn, and they have to stick to their guns of combating inflation and can't pivot too early, otherwise you're going to enter high risk inflation risks and hyperinflation scares, then the path of price we're starting to see into 2024 is dollar still holding strength, gold seeing some more strength, breaking above the 2000s, outflow out of risk assets like equities and risk currencies being a bit more bearish, yen seeing some more aggressive bullish rebounds, oil being more bullish as well, and energy costs rising with geopolitical tensions, right? Now, in the example of gold here, what is this? Am I right? Did I get that right? I didn't see your chat. So we're going to see consecutive bad data reports. the final nail is going to be some geopolitical events and other stuff. It's not like the final nail. It's all of these events are gonna work hand in hand. You just have an increased probability historically that if US is facing economic downside and can't get any more support from the central bank, they're going to look to bring in resources and wealth externally, and they're going to cause some global conflict, whether that's direct military conflict from a physical standpoint, or whether that's an economic Cold War to bring in more money and resources. So those are the catalysts that would obviously lead to more demand in gold and appeal to its safe haven side, because you have declining global economic data, weakening global economic activity, geopolitical tension starting to escalate. You have this outflow out of risk assets and the inflow into something like gold and other safe haven asset classes. Now, we can even see here as we're going into like the monthly time frames. So you can see exactly why I wanted to see deeper corrections during the dollar domination phase to the 1500s before buyers came into the scene, but we just went into the 1600s there. But it's still the same idea of holding macro bullish structure, getting a correction of some of these impulsive bullish moves, still trading and holding above previous crisis highs, right? We're seeing much stronger bullish sequence of events take place here as well. We just need those events stacking up to be the catalyst for us to really trading above the 2000s and see an extended higher time frame leg up into the 2200s. Now, as we're still just starting to see the cooling signs of economic data, and especially into the new year, we could still easily get these corrections before continuing higher. But overall, the base case for gold bulls in 2024 is looking a lot higher probability and looking very appealing for some intraday plays, just sticking to the bullish bias, longer term swing plays, even with economic uncertainty, a potential yearly investment after a dip and gold extending to highs. Now, from a more near-term perspective, if we still have some resilient economic data, don't really have any new fear tensions, a gold correction into the 1850s is not out of the ordinary at all. Otherwise, very clean movement back above the 1960s with further weakening data, cracks in the financial markets being exposed with like the weakening we've seen in China. And we can start to see, of course, a ripple effect occur from that. Geopolitical tensions escalating and from a technical standpoint, trading above the 2000s. Can for sure see us printing some new historical highs there on gold. For a lot of you who are not understanding, let me try to help you paint a visual picture of what to expect through 2024, right? Maybe you need to close your eyes. Maybe you need to write it down. Maybe you need to draw a picture yourself. But the trillions of liquidity, whether that was flooded into the banking systems, given to these businesses as they took out loans at 0% and so forth, the stimulus checks that were given to citizens in North America, from the start of the pandemic, majority of that is running dry. The feds are not going to be injecting any more new money into the system. They cannot afford to pivot. They cannot afford to cut interest rates too early. They can't afford to increase, to turn on the money printer again and increase money supply, because if they do that, inflation will 1000% guaranteed spiral out of control to hyperinflation levels within the timeline of a year, completely destroying the US economy. And I'm not talking about that leading to a recession. That would lead to a depression. right? So they can't do that. So you have the trillions of liquidity running dry, interest rates at 5% when it used to be at 0%. No more new money coming into the economy and markets there, right? These institutions and businesses no longer having as much business to business activity with interbank lending or taking loans out from the central bank because they don't want to at these higher debt rates with the more evident risk. The same time, you're having the personal income, personal savings of the general citizen bleeding dry, credit card delinquencies higher than ever, credit card debt and consumer debt passing $1 trillion, inflation still not at normal levels and still double what normal levels are at 4% and going to be fluctuating there, interest and debt rates staying up higher for longer too, right? 2024 is not looking good for economies. It's going to be tough times. It could be tougher times than the pandemic, to be honest. The pandemic had a lot of shock value with it because it was this new global event of this freaking zombie virus that's going to kill everybody. And we had this unique event occur where people were locked down to their homes. But 2024 is going to be far further economic pain if you understand where we have come from the pandemic. Unemployment rate is going to continue to rise. There's going to be more people unemployed, even less income, even less economic activity. Delinquency rates are going to rise. People are not going to be able to pay back their loans and their debt, their credit, and so forth. Personal savings depleted. People are going to struggle to get their general basket of goods as inflation's still going to be generally elevated, but people aren't going to have the money to spend. Right? During this period of time, there's going to be more media propaganda of geopolitical tensions and threats, might even bring back focus on these viruses. Again, might even see new things like aliens being brought to the table to distract people. Trust me, I'm not joking around here. Right? During these difficult times, as global economies feel this pain, it's not just the US. The UK's in the same path, Canada's on the same path, parts of the Eurozone are on the same path, Asia is on the same trajectory. During these periods of more economic darkness, the whales in the markets that are still going to be making their money, they're just going to be moving their money from one asset class to another. You're going to see safe havens primarily stronger, commodities such as oil holding more weight, which is just going to put more pressure on inflation. You'll see risk currencies and risk assets a lot more bearish, probably not much faith in crypto, probably going to see a correction in the stock market without the support of the Feds or any chance of pivot in declining data. Right? Higher probability of seeing corrections in real estate, more bankruptcies, more foreclosures. A lot of this is inevitable. During this period of time, safe havens will, of course, hold more strength. So that's why we're looking at gold here. And what we're saying lines up with the current structure. It lines up with the key price points of interest. It lines up with the price positioning. Right? Now, let's look at dollar individually, because dollar is very, very important to understand through 2024 as well, because it is your primary market driver on dollar pairs with its position as the world reserve currency. Now, during times of economic global turmoil, even though the US economy may be facing weakness, if global economies are facing weakness, dollar's still going to hold appeal from a market perspective as the world reserve currency and as a safe haven currency, because it's still backed by the largest economy in the world 90% of global business transactions are still in the dollar, still holds that position as petrodollar, and everything we discuss in the educational webinars. Now, when you're looking at dollar here, right, you can see we had this short-lived downside at the very start of the pandemic. Why? Well, obviously, interest rates were dropped to zero and money supply was exponentially increased, which is going to mean less supply, which is going to mean less demand of the dollar because all the demand is in risk assets in the stock market because Feds are pumping the markets, and more supply of the dollar, right? But as we had that corrective phase, we just came back to this previous price sensitivity area and demand zone, and then into late 2021, when we had Russia invading Ukraine, you had some more appeal in the dollar as a safe haven currency. But more importantly, into 2022, Feds began the most aggressive rate hike cycle. This saw dollar with excessive upside volatility. Now, the one thing that's dangerous is excessive upside volatility in the dollar creates and has a lot of negative implications on global debt obligations, on, of course, other countries' currency values, and of course, global business activity. When dollar goes up too much, too fast, it has a lot of downside on other global countries. Hence, during this period of time, we saw major countries such as China, Japan, UK perform currency interventions because their currency is already devaluing on top of dollar being so strong, especially in the example of the macro rate differential between the Bank of Japan and the Federal Reserve. But nonetheless, you can see we had this large rally, impulsive bullish moves, new higher time frame highs being printed that we haven't seen since like 2000s, right? So still maintaining beautiful macro bullish structure from a technical perspective here too. Now, we've had this aggressive correction and pullback phase as inflation started to drop because of the Fed's front loading of rate hikes. And of course, the base effect was passed there and inflation starting to come back into the sticky zone. And majority of the rate hikes were priced in, plus price positioning and setting up through 2023. But that is a 50% correction of this overall rally from late 2021 into these peak highs. And that's also conveniently retesting that area we broke above, where now inflation is still seeing trouble at the 2% point. And to maintain there, and Feds are going to keep rates up. And if geopolitical tensions continue to escalate on a global stand, and if we don't trade above the 101s there, we can easily see dollar still trending back to these highs, just not as impulsive, in a slower, steadier fashion. And we can easily still see dollar from a macro perspective going into the 120s. Why is this so important? Well, if this occurs, especially going into 2024, and we don't see dollar breaking below 101s here, US inflation is still seeing trouble to hit the 2% targets and maintain there, right? We're seeing geopolitical tensions escalate and declines in global business and economic activity. Then there's an increased probability of dollars remaining a lot more bullish through a macro period of time, which means primarily on an intraday perspective or swing perspective, even scalping, it's going to be a lot easier playing GBP USD sells, Euro USD sells, and USD CAD buys, right? So from a higher time frame standpoint, very key bullish sequence of events, fundamentals supporting that. Very nice bullish structure still here as well. Respecting very key historical price points you can see across the board. And for a base case, us holding above 101s is still very macro bullish on the dollar. But remember what I first said about dollar upside volatility. If dollar increases to the upside in too fast of a fashion, right, volatility, then there's a increased probability other countries will do currency interventions. So what I'm expecting is, because we're going to be seeing declines in US economic data, but the Feds will still be holding rates up through 2024, dollar's going to have on the intraday very choppy price action to the upside. I think it's going to be very slow and controlled, almost like the sequence of events we've been seeing over the last month, where you have dollar extending bullish, aggressive data and event-induced pullbacks, like we've already seen a couple of China currency interventions and India currency interventions. We've already seen the data-induced pullbacks. So I think dollar's going to be making its way back up to these historical highs printed, right, and closer to this price point of interest over the course of like 6 months, 8 months, rather than 3 months. Okay? So that's very important, is that you could have these aggressive volatile waves with how dollar is making its way to the upside there. Right? And let me show you guys a better example too. This is a prime example. Versus dollar going up like this, I see it going up like this. Right? Still overall, through this period of time, dollar increased in value, but a completely night and day difference in terms of the timeline and volatility. Right? Even something more like this, where slowly creeping up, still having some aggressive pullback phases. That's how pretty much if dollar holds above that 101s area, and we still have inflation seeing trouble at 2%, Fed still keeping rates up and neutral rates higher for longer through 2024, still seeing geopolitical tensions escalate. This is like a copy and paste of how I would see dollar increasing in value back to these highs. Does that make sense to everybody? That's very important to understand, because it's going to be very night and day different when you're playing the intraday time frames. You have to get used to seeing some aggressive pullback phases on your pairs like Euro USD, GBP USD, and so forth, which we've already 100% noticed. Look at how dollar started to stabilize here, right? Previously at this 102 price point during the domination phase, one retest, boom, to new highs. Here, pullback, retest, 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 still stabilizing, not fully showing buyers in control just yet. A lot more controlled upside. Right? It's going to be like this. The upside. Going back to the previous highs. I'm not really expecting it to be like this. Does that make sense to everybody? It even looks like a pattern, like it goes with a little weight, like a pretty continuous pattern there too. But still overall bullish structure, still this key price point of interest above 102s. Right? So simply put, then on pairs like Euro USD and GBP USD, where you still have that rate differential, you'll have less demand in your basket of risk currencies, such as Euro and GBP versus the world reserve currency, of course, being the dollar. If we can't trade back above 1.13s here, give or take new yearly price setups, overall going to be expecting us on the weekly and monthly time frames to be creeping down back to those parity points, 1.0 and potentially lower, in a more slow and steady fashion there. Right? Even when you're just looking at general structure here in the dollar pairs versus that impulsive move where you had fear, uncertainty, and doubt in the Eurozone due to Russia invading Ukraine. And then, of course, you had Feds with their aggressive front loading of rate hikes. This has still been a 50% correction, where as we've come to that 50% correction point, we've clearly seen slowdown of buyers in control there, right? So we're still maintaining macro bearish structure, pullback from these new higher time frame lows that were printed still have potential to hold below this area and be digging back to those price points. And GBP USD has that exact same price formation. Right? It's just that I'm not expecting as impulsive bearish moves compared to the dollar domination phase when you had less demand in risk currencies with Russia invading Ukraine. I'm expecting a lot slower, more controlled, choppier downside back to these price points. Right, still maintaining bearish sequence of events, a pullback coming from new lows being printed there. This looks very similar to this. Right? And then you can see, compared to the impulsive bearish downside, like here, this is like for example, this is like 3, 6, 9 months. This is 3, 6, 9, 12. It's like a year, 2.5 years almost, going back to that same low. Right? And then USD CAD, obviously more of the inverse, where it has a lot more room for upside, in my opinion, going back to these 1.45 price points and so forth. Very strong support there. Bullish impulsive price action. Dollar strength holding more weight. Rate differential between Feds being a bit more hawkish compared to the Bank of Canada. Now I'm expecting it to be slow and steady revisiting these highs because you're still going to have Canadian dollar strength attributed to oil being more bullish, but it's not going to overtake dollar strength on a macro perspective, in my opinion. Yeah, so the base case for dollar bulls through 2024, gold bulls for sure looking a lot more evident there. And that's very easy to translate that information for dollar onto the inverse correlation on GBP USD and Euro USD. And obviously just continued upside on USD CAD. Now on our yen pairs like GJ and UJ, with economic data declining, right? With geopolitical tensions bubbling, we're going to see very aggressive corrective waves. But the higher time frame bullish bias will not be broken unless two things occur. Three things pretty much, right? Either you have a new global crisis equal to the 2008 GFC or the pandemic, or you finally get one of the two central banks pivoting. Either the Bank of Japan finally giving signals towards coming out of negative interest rate territory and tightening financial conditions, or the Bank of England giving signals towards pivoting and doing rate cuts. Maybe the UK economy will see so much weakness, Bank of England pivots early and, fires the gun a little bit early there and starts to pivot. Other than that, what we will see take place is very aggressive potential data-induced and event-induced pullbacks, like we saw with the banking sector failures or with COVID fear, right? Where we had new COVID variants coming into play, or banking sector fear, or bad economic data, and so forth. Now, those lead to very aggressive intraday bearish moves, sometimes lasting days or if not weeks, but does not shake the macro rate differential of Bank of Japan still keeping interest rates in the negative and the ultra loose policy. And of course, the Bank of England still keeping rates up higher for longer to combat inflation. What also still looks very evident is as Brexit has now found a solution, us going back to these pre-Brexit prices, right? So we still have very strong higher time frame bullish confluences from a fundamental and technical perspective, and it looks pretty smooth sailing still up into the 190s, 195s before seeing any type of aggressive pullback phase or correction that can be data or event induced, right? And even from a more near-term perspective, even the new yearly candle having an aggressive pullback phase into the 175s would still be very bullish, but it doesn't look like we're even going to be getting that. We had this aggressive bullish breakout, liquidity grab here, and still looking like bulls are in control, where we can just be trending back up to the 195s. So from a macro perspective, even into 2024 there, give or take some aggressive event-induced pullbacks, if the Bank of Japan doesn't shift their policy stance, if the Bank of England doesn't shift their policy stance, if we don't get a new major global crisis event to shift market sentiment and lead to an aggressive inflow in the Japanese yen and outflow out of the British pound as a risk currency, then what we can see a higher probability is that we could still be extending up into the 195s here on GJ. So getting these aggressive event or data-induced corrections, but still maintaining macro bullish sequence of events and those corrections just setting up better pricing for continued buys to pre-Brexit prices here. Bank of England still has some more work to do with tightening conditions and getting inflation down to goals. Bank of Japan is still not satisfied, as inflation in Japan, especially with some of the Tokyo CPI numbers we've seen, is still skewed to the downside a little bit. So the macro policies aren't shifting anytime soon. We haven't had any signals of it anytime soon, or we haven't had any signals of it yet either. So still very macro bullish, looking for a similar run like this, which we've been playing and literally calling over the last 3 years here, just looking for large corrections and continued macro buys on GJ. And we still got rooms digging up into the 190s and 195s, even if we get a deeper correction here for the new yearly business setup, new business year setup. So nothing really to refresh or discuss on GJ. That's still the same as the last macro higher time frame analysis webinar. Similar idea here with UJ. Still very bullish. Looking like we're going to be going back into the 150s before we see any signs of Japanese currency intervention there. Now, what's going to be very interesting is equities. As we're going to have rates up higher for longer, troubles with inflation, Fed's not pivoting even if unemployment rate continues to rise, we might see sweeps of these high areas again into the new year. But overall, if we don't break higher, it does look like global sentiment is going to turn more sour. You're going to have way more demand in the dollar, more demand in your safe haven asset classes, weakening global economic activity, a lot of the liquidity through the pandemic running dry, whales liquidating positions from historical high prices, having a correction and a pretty controlled correction, not really calling a crisis, which in the example of US 30 can easily be coming down to 32K, 31K again. So a few key points is that if we don't get any signs of the Fed pivoting, if inflation's still seeing trouble, if economic data continues to weaken, but it's not going to lead to the Fed shifting their policy stance, as it's within their FOMC expectations and signals they've given us, especially with employment data. If we see geopolitical tensions continue to escalate, then confidence in global equity markets and global business is going to decline. We have a higher probability of sweeping these highs for the new yearly period, or just starting to break back below that 34,500s area and getting larger corrections, pretty controlled corrections, still maintaining price stability down to 32Ks, 31K, before seeing where economic data is sitting well down the line then. So it's very difficult for me to see any further stock market buys besides short-term pullbacks to set up potentially big short correction positions with what's starting to bubble up and develop through 2024 from a global economic perspective. Increased probability of geopolitical tensions, policy lag effects becoming more apparent, inflation still seeing trouble back into the sticky zone, debt rates, of course, continuing to increase, and weaker consumer and workers there. We're already seeing cracks in the financial markets exposed with China and the turbulence that's going on with their economy, leading to the surprise rate cuts and stimulus that's really like putting a bandage on a machete wound. It can sort of cover up some of the bleeding, but it's not looking too good. And it's difficult for me to see any more stock market buys unless we get Feds pivoting, inflation goals reached, soft landing narrative supported, and breaks above 36K. Otherwise, the sweep of the highs or starting to see these larger corrections is looking way more evident in my opinion. But that's just a macro higher time frame analysis review webinar that we like to do every month in Capital Hungry. Zoom out, look at the higher time frames, review some of the fundamentals, review some of the price positioning, helps us forecast what's going on into the potential future, helps us have a good understanding of what's going on in the world and going to be impacting our societies to come. I'll be doing an updated oil and Bitcoin analysis this week as well. I'm going to save and upload this, and then we'll, of course, do an intraday trade ideas webinar for fresh this week.